Hello everybody, it's Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. I want to welcome you to another one of my ongoing videos where I cover various types of stocks utilizing the FastGraphs Fundamentals Analyzer software tool. In today's video, I'm going to take a look at utility stocks, and I'm going to look at 7 what I consider to be reasonably valued to not attractively valued utility stocks out of the 85 publicly traded utility stocks in the United States that are actually available. Now, there's a lot of notions about utility stocks that I want to try to cover in this video as well. And, things like, that they're, first of all, they're safer than other type of stocks. Other people think of them as bond alternatives. There's all kinds of different attitudes that people have about utility stocks, some of them true, some of them not true. So let's go ahead and go on to FastGraphs here, and let's look at the 7 utility stocks that I've put together here for this video. Let's organize them by, first of all, by earnings yield, because I'm just like in any other stock, I'm looking for an earnings yield of 6.5% or higher. Now I've taken a little latitude with utility stocks to come up with these 7. I've got the earnings yield on Sempra Energy of about 6.14%. As you'll see when I get into it, moderately overvalued, which I would more refer to as fully valued, but it's still pretty attractive here with 3.34% dividend yields. From a standpoint of dividend yields, utilities are theoretically considered to have, be higher yielding stocks than most, and that's probably true. I've got MDU Resources here, which is a multi-utility with the lowest dividend yield of 2.61%, all the way up to South Jersey Industries, which has a yield of 4.9%, approaching 5%. Now, a couple of other ideas or notions about utility stocks is they don't grow very fast. These are the 10-year historical growth rates of these 7 utilities here. And you can see the lowest would be MDU, ironically, at 1.6%, and the highest would be 5.7% out of UGI. And UGI is one of the almost exceptions to the rule here as far as utility stocks go. But, they're not really fast growing stocks. Now, their forecast growth is also going to be about average or slightly below average. Now, they range in here from a credit rating of no credit rating for UGI, which simply means they didn't request one, to A- ratings for Spire. And then I've got, triple B- with National Fuel Gas, which is a gas utility. And then I've got MDU at triple B+ and Sempra at triple B+, one notch away from A. So there's decent quality in these 7 particular utility stocks. And they're all, in this case, attractively valued. But I want to talk about some of the other notions about investing in utility stocks. It's commonly promoted that utility stocks have advantages to investing in it because they operate, first of all, business that most people understand. They sell electricity to people's homes, or they sell natural gas, to people's homes, etc. Associated with that is the idea that utility stocks provide essential products and services. Everybody needs electricity, natural gas, or water. And I don't have a water utility in this group because most water utilities are overvalued, but that is one of these essential products and services that utility stocks, tend to provide. I buy that one. That's really one of the notions about utility stocks that I completely agree with. But then other people will say that because they provide these essential products and because they have limited competition, that they're considered a very defensive investment. We're going to test that idea here a little bit later. But, that's a common notion that utility stocks, some people even go as far as to say they're almost bond-like. And with that notion comes the idea that utility stocks will hold up better in a stock market downturn. That's another notion that I want to test with you because, again, a lot of people have these opinions. And one of the things I like best about working with the FastGraphs Fundamentals Analyzer software tool, it allows me to test these notions under real-world situations and applications and determine whether or not these notions are actually real or whether they're just figments or myths. And, utility stocks do tend to pay high levels of dividends, but they also, don't have necessarily a lot of growth potential to them. So if you're looking at disadvantages to investing in utility stocks, they're in a mature industry is what some people say. Their growth potential, therefore, is limited. In other words, and they also have to work within the confines of their territories. Now, some utilities are diversifying, even going international, getting into other items, but they do have limits in terms of the type of growth they have. That's something to be aware of when you're considering utility stocks. They are regulated, okay, and therefore their profitability can also be limited, but that can also be an advantage. If there's issues, they can, go to the regulatory commissions and request rate increases and things like that. And usually the regulators will work pretty well with utility as long as they don't feel like they're trying to gouge the public. Another negative, though, a big disadvantage utilities, which I am going to cover extensively here in this video, is the fact that they use a lot of capex. They have large outlays of capital that in many cases exceed their cash flows, and they don't tend to generate any free cash flow as a result. That's something that always has concerned me when I'm looking or thinking about investing in utilities. But I do invest in utilities and I do utilize them because I do think they do have a purpose in a lot of, especially dividend growth portfolios or retirement, portfolios. But this notion that they're defensive is not necessarily true, as I'll show you here in a moment. They're not immune to having, big declines in their share price for different reasons. That can be the overall market decline. That can be management, makes poor decisions. A lot of that has happened with some of the nuclear energy projects that utility stocks lost billions of dollars on. In that regard, there can be accidents or mistakes. And then, of course, if they get crossways with their regulatory boards, the relationships can really slow down rate increase decisions and things like that. Another thing with today's low interest rate environment, I think it's very important to be, because they do have they are considered to be bond-like by many investors, they do tend to be very sensitive to interest rates, okay? So that's something that I further believe that investors need to be cognizant of. In a rising interest rate environment, that could have a major impact on utilities. And keep in mind, out of the 85 publicly traded utilities, I've only found these 7 that I would even consider today. So, safety is not necessarily a truism when you're talking about utilities. Now, they do tend to be safer relative to other kinds of stocks or kind of aggressive growth stocks and things like that. But again, they don't come with any guarantees on them. So, this idea that utility stocks are defensive is questionable. But anyway, these are the 7 utility stocks that we're going to look at. Now, what I'm going to do, I'm going to turn to the new version of Fast Graphs because I want to go through these pretty quickly as I kind of go through some of these characteristics and test some of these notions that we talked about. So we're going to start with Edison International. Edison International is a BBB rated utility. It has about 55% long-term debt to capital, which, by the way, considering the amount of money that's being borrowed today because of low interest rates by corporate America, that's not really a high level of debt. So, that's one of the notions that utility stocks are heavily indebted. I don't find them any more so than others. But let's look at the long-term record here. I'm going back, and I'm going to, go back to the most recent recession we've had, the 2001 recession, the 2008 recession, and of course the COVID-inspired recession, which, technically we're still in, or, I'm not sure how this recession is really going to be measured in hindsight a few years from now. But regardless, let's test the notion of Edison International being a defensive play. So during this recession, it actually did show, I'd say, defensive characteristics in that, the company's profits actually grew and the business grew. Now, their dividend apparently was eliminated, and I'd really like to check that because that seems unusual to me considering everything else I'm looking at here. But if I look at the 2008 recession, I don't consider this very defensive, other than the fact that the company did continue to pay its dividend and, increase its dividend at a relatively low rate, I might add. If I look at the long-term performance here, you can see that the dividend growth rates have been kind of spotty. I want to shorten that to 10 years, about 8% dividend growth, which is actually better than I thought. So, the company is a good dividend growth stock. You can see the price follows earnings. You can see the classic, when it gets undervalued, it eventually wants to move back into alignment. Sometimes that takes years like it did here. But during the years where it's doing that, those were very profitable years. When it does get overvalued, it's very vulnerable, as you can see. And then, of course, in COVID, we had another big drop. So I wouldn't call it necessarily defensive. It does pay a 4.5% dividend yield. It's got an earnings yield of 7.6% and a PE of about 13. So, all in all, I would say this is a good, solid choice for high current income if you're looking for high current income today, as a utility stock. It's not going to generate a lot of capital appreciation. You can see the growth has been about 4%. If I shorten that to more modern times, it falls down to about 3%, which is kind of normal for utility stocks. So again, they don't tend to grow very fast. They can be defensive to some extent, but yet on the other hand, that doesn't mean that their prices aren't going to drop in a recession like we saw in '08, and again, like we saw with the actual COVID recession. Okay, the next thing I do, I want to go into fund graphs though and make a real strong point here, because if you look at fund graphs, this is capital expenditures off of the cash flow statement. Okay, the thing I pointed out earlier is these guys have to spend a lot of money in infrastructure, building out their plants and so on, so they can provide energy to a growing and energy hungry, public that they serve. When I look at the standpoint of operating cash flow, what really disturbs me about them, or not disturbs me, but concerns me, it's something that I think every investor in utility stocks should be aware of. They actually generate or actually spend more CapEx than they tend to generate in operating cash flow. And then free cash flow is abysmal. As you can see here, they generate almost no free cash flow. In other words, if I take capital expenditures off of there, you can see that year after year they have negative free cash flow, mainly because they're spending so much money on infrastructure. That's something to really be concerned with. So if I look at them using the new faster version of fast graphs here, when I look at operating cash flow, we've had pretty decent coverage. They did, their operating cash flow collapsed during COVID. But if I look at them from a free cash point of view, for the reasons I've already stated, the company has very, very poor, free cash flow, actually negative free cash flow. And yet, they do provide essential services and so on. From an earnings point of view, they don't really look too bad. So let's go on and go through some of the others here, utilizing the same kind of concepts. I've kind of established the base here for you. The next would be MDU Resources. This is a multi-utility stock. Very, very spotty growth, long periods where it doesn't grow. You can see this. There's actually more volatility here in this stock than you would think a utility stock would provide. You have, from this peak to this trough alone, was over a 40% drop in over about a year and a half's period of time. Was it very defensive during the Great Recession? Not so much, in my opinion. We had this huge drop. COVID, it did drop precipitously, but it recovered very quickly. So you might want to consider that defensive. If I go back to the 2001 recession, it had a pretty significant drop in value, but it had a very excellent dividend record. And I think that's really important. You can see that the dividend has increased, year after year after year here. Once again, when you look at dividend growth rates, average about 3 or 4% for this company. That's good. That does give you a slight inflation hedge, but again, it's not, the type of dividend growth you can get with some faster growing dividend growth stocks out there. From a standpoint, again, if I go into looking at it from the point of view of CapEx, huge CapEx, if I measure that CapEx against operating cash flow, we see that, in this case, the operating cash flow, at least for the last several years, has been pretty close to equal or even exceeded CapEx. But once again, when we take a look at free cash flow, and I'm going to do it in this form here, when you look at free cash flow, you see this abysmal record again, another utility that really doesn't generate any free cash flow. Now, there's also a notion out there by some investors, and utility stocks, I think, are, a good way to kind of, debunk that myth, and that is that the best valuation metric is free cash flow, which, by the way, is a very close cousin, almost virtually identical to Warren Buffett's favorite called owner's earnings. And the reality of it is free cash flow doesn't apply at all when you're looking at utility stocks, as I'll kind of illustrate as I go through, the rest of these companies. The next one we're going to look at is South Jersey Industries. And once again, I do want you to see that, stock price follows earnings. Periods of overvaluation tend to, not produce very good results as the company's stock price eventually moves back into fair value. This particular company has done pretty well. This may be one of the ones that feeds the myth, or I don't even know if it's a myth. In this case, it's not a myth, that it's pretty defensive during a recession. Now, it was vulnerable during the COVID recession because it was overvalued, but it's come back into fair value. It's attractively valued now, a 4.9% dividend yield. The company is BBB rated. and trading at around 15 times earnings with about a 6.68% or 6.7% earnings yield, with, again, a very nice dividend yield. But once again, when I look at free cash flow, for the same reasons, I'm not going to bore you going back into the fund graphs, large capital expenditures literally eat up all of the company's ability to generate free cash flow. The next one I want to look at is Sempra Energy here. This is a in Southern California utility stock. Really nice earnings record here, one of the better ones of utilities, with over a 6.5%, approaching 7% growth of earnings, dividend yield about 3.25%, trades at a slight premium, as I mentioned earlier. I'd like to see this one a little cheaper, but this is a utility stock that is at least reasonably priced relative to many of the other utility stocks that are excessively overvalued. One of my favorites I covered in a recent video is my own Florida Power and Light going to the other coast, or known today as NextEra Energy. And again, you can see what a great record it has, but you can also see how highly valued the NextEra Energy has actually gotten. Now, Sempra Energy is close to being attractively valued. I'd want to see it just slightly cheaper, but with a 3.25% dividend yield, probably not going to go too bad investing in this particular utility stock today. UGI is a gas utility. I like the picture here. It's got a very nice historical record. It's got a great dividend growth record. That's the white line on the graph. Almost a 3% yield that you can get. I believe most of these stocks are down a little bit today, which would be a good reason to want to invest in them. Yeah, we have a little bit down 39 cents or 0.8% today. Maybe gets the yield closer to that 3% number, but you can see what overvaluation did to the stock price. From a standpoint of being defensive in the recession, this one was pretty defensive in all three recessions, and I would say it was pretty defensive during COVID as well, if you measure it from fair value. But the point is, it entered, the COVID pandemic, recession being very, very richly valued. And that's why I think you saw this one fall so much. I like this utility. I'm long it. I think it's got good long-term potential as utilities go, and it could really round out most dividend growth portfolios. The natural fuel and gas is kind of a slow-growing utility. And this one is really kind of interests me because look at the volatility here. Look how the market can just really get out of hand with expectations. The Ben Graham, in the short run, the market's a voting machine where people get all excited about a stock. I don't see any reason why they got excited here, but they did. And then, of course, that just resulted in a huge correction. Then they got excited again. That resulted in another huge correction. Then the stock price kind of went sideways, but still a lot of volatility up and down. Had a drop in earnings at COVID. They did maintain their dividend, even increased it a little bit. And now they're expected to start earning money again. They got about a 3.5% dividend yield, blended earnings yield of 7.76%, PE of 12.89%. So this is a utility stock primarily for income. This almost is more bond-like. Now, you can make short-term pretty interesting gains on this stock, at least if history's any guide. But, it's not going to be one that I think is going to generate necessarily a great deal of growth. Expectations, there are no long-term growth rates. We are looking at decent growth for the next year or so, but we don't have any analysts giving us any projections longer term. And then last but not least is Spire, another one that's a little bit fully valued, I would say, but I really like the fact of the consistency of this one. Here we have, very good recession resistance during the 2001 recession. It actually did pretty well during the Great Recession as well, considering that it was actually rising through most of it before it finally succumbed to the pessimism. And a lot of that might have had to do with forecasts of a down year, where they did have a 14% drop in fiscal 2010, which ends in September, I might add. So that's something to, recognize the fiscal year on this stocks. 3.7% dividend yield, pretty attractive. Otherwise, it's A- rated, probably the highest quality from that standpoint, utility in the group here today. But, there you have it. Utility stocks come just like every other stock in all different sizes, shapes, and flavors. As I pointed out, when you look at these stocks, they have some similarities to them, but there's a lot of differences as well between one utility stock to the next. It's a market of stocks, not a stock market. I think the big issue with these guys is to recognize the amount of capital expenditures that really limits their ability to generate any free cash flow. In fact, most of them generate negative free cash flow. that's something to be aware of. They, because of their essential services or their regulatory nature, they've held up even though they've done that. They're able to raise capital when they need to. They're able to get rate increases when they need to, generally speaking. But anyway, that's what, my take on utility stocks. I think these are the only ones that I think are reasonably attractive in today's market. Like always, do your own research and due diligence. There's no substitute for comprehensive research and due diligence, in my opinion. Anyway, if you enjoyed this video on utility stocks, I hope you did. Give me a like, a thumbs up, ring the bell, subscribe to the channel if you haven't already. And I want to thank all of you. Our channel just went over 25,000 subscribers last week, and that's very gratifying for us, and we really appreciate that. And let's keep spreading the word, and get more people coming to look at this channel. Thanks for watching.